What is CFD trading? Up to this point, we've covered stocks, forex, and commodities. In this lesson, we shift our focus to contracts for difference, CFDs, a derivative instrument that functions differently from traditional assets. Rather than taking ownership of an asset, CFD trading involves speculating on price movements, enabling traders to potentially profit from both rising and falling markets. We'll examine what CFDs are, how they operate, their key advantages and associated risks, and the steps involved in starting CFD trading. What is a CFD? A contract for difference, CFD, is a financial agreement between a trader and a broker to exchange the difference in the price of an asset from when the contract is opened to when it is closed. In simple terms, CFD trading allows you to speculate on price movements without actually owning the asset. With CFDs, you can trade on a wide range of markets, including stocks, commodities, forex, and indices. Instead of buying physical shares or commodities, you enter into a contract that mirrors the asset's price movements. If the price moves in your favor, you make a profit based on the price difference. If the price moves against you, you take a loss. Imagine you're watching a soccer game between Team A and Team B instead of playing. You make a bet on Team A winning. If Team A wins, you collect your payout. If Team A loses, you pay out the loss. Similarly, in CFD trading, you're not buying stocks or commodities, but you're trading based on their price changes. If your prediction is right, you earn a profit. If it's wrong, you incur a loss. CFD trading versus traditional trading. Here's how they compare. Ownership: in traditional trading, you own the asset like a stock. In CFD trading, you don't own it. You're just speculating on its price. Leverage: CFDs allow you to trade larger positions with less money, increasing both potential gains and risks. Flexibility: with CFDs, you can profit in both rising and falling markets, while traditional trading only benefits when prices go up. Trading costs: CFD trading involves spreads, overnight fees, and sometimes commissions, unlike stocks, which typically have standard commission fees. CFD trading, margins and leverage. CFD trading uses margins and leverage, which can amplify both profits and losses. Here's what you need to know. Margins. Margin in CFD trading is the initial deposit required to open a position. It's a fraction of the total value of the trade. There are 3 types of margins. Initial margin, the minimum amount needed to open a trade. Maintenance margin. If your trade goes against you, you may need to add more funds to keep the trade open. Margin calls. If your account falls below the required margin, your broker will ask you to deposit more money or close the trade. Leverage. Leverage lets you control a larger position with less capital. It's expressed as a ratio, e.g., 1:10 leverage means you control 10 times your deposit. Example, if you use 1 leverage, a $1,000 deposit allows you to control $10,000 worth of assets. Risk warning: while leverage magnifies profits, it also amplifies losses. If the trade moves against you, losses can exceed your deposit. How CFDs work: buying and selling contracts. In CFD trading, you can make money whether prices go up or down. Here's how. Going long: buying. If you believe an asset's price will rise, you buy a CFD. If the price increases, you profit. If it drops, you lose money. Going short: selling. If you think an asset's price will fall, you sell a CFD. If the price drops, you profit. If it rises, you take a loss. Let's take an example. Imagine you're a trader interested in the tech industry, and you believe that the stock price of a fictional tech company, Company X, will rise due to its upcoming product launch. However, instead of buying actual Company X shares, you opt for CFD trading. Let's take it step by step. Opening the position. Let's say Company X is currently trading at $100 per share. You believe the price will rise, so you decide to buy a CFD for 100 shares of Company X and open a long position. The total value of your position is $10,000, $100 shares x $100 each. But due to leverage, let's assume 1, you only need to deposit $1,000 as margin. Price movement. Scenario A, the price rises. The share price of Company X rises to $120. Your CFD position is now worth $12,000, $100 shares x $120. You decide to close your position and realize your profit. Your profit is $2,000, $12,000, $10,000, which is more than your initial margin. Scenario B, the price falls. The share price of Company X falls to $80. Your CFD position is now worth $8,000, $100 shares x $80. You decide to cut your losses and close your position. Your loss is $2,000, $10,000, $8,000, which is more than your initial margin. So, as you can see, in CFD trading, you can speculate on price movements without owning the underlying asset, leading to potentially high profits or losses. Benefits and risks of CFD trading. The previous example shows that if the prices had fallen, you could have faced amplified losses that exceeded your initial margin. Let's take a look at some of CFD trading's benefits and risks that you should look out for. Benefits: flexibility, the ability to trade on both rising and falling markets. Leverage, you can control a large position by just depositing a fraction of its value. Access to global markets, the ability to trade on a wide range of international markets from a single platform. Risks: leverage risks, potential for significant losses if the market moves against your position. Market volatility, CFD markets can be unpredictable and can move quickly. Overnight charges, you may be charged additional fees if you hold a position overnight. Getting started with CFD trading. Here are some tips to get you started with CFD trading. Research and choose a CFD broker. Look for a regulated broker that offers educational resources. We will look at the importance of brokers in the next lesson. Open and fund a trading account. Complete the registration process and fund your account, keeping in mind to invest only what you can afford to lose. Start with a demo account. Practice trading strategies without risking real money. Begin real trading. Start with smaller trades to understand market dynamics and use tools like stop-loss orders to manage risks. Lesson summary: CFD are contracts that let traders speculate on price movements without owning the asset. Unlike traditional trading, CFDs allow profits in both rising and falling markets. Leverage lets traders control large positions with a small deposit, but also increases risk. CFD trading involves costs like spreads, overnight fees, and potential margin calls. To start trading, choose a broker, practice with a demo account, and use proper risk management. Now that you have a clear understanding of how CFDs work, the next step is selecting a reliable broker.